Thank you for joining me. I'm Alex, and I want to talk about CVS today. So CVS does the same thing Walgreens does, and kind of sort of Walmart as well. So mostly pharmacy, some convenience store, grocery store, kind of everything type stuff. Current price is $72.52, which gives them a market cap of $95 billion. Definitely not a small company, kind of like maybe a sixth of the market cap of Walmart. So definitely a pretty big company. Dividend yield 2.87% with a payout ratio of 33%, which is definitely not too bad. Revenue $256 billion, which is half of what Walmart does. So very big revenue there. Earning $6.6 billion, which again is about half of what Walmart does. Which gives them PE of 11 with a forward PE of 9, which is also fairly nice. A company with a PE of 9 is pretty much always a buy unless there's a really good reason against that. Total assets $222 billion, total liabilities $158 billion, which gives them a total stockholders' equity of $63 billion. Obviously, pretty nice balance sheet. It could be better, but it could definitely be worse. They've increased it on both sides quite significantly over the past years, which is not necessarily a bad thing, but one has to question whether or not it's in the best interest to grow the revenue or not. But then revenue up 25% is pretty huge. So risk factors are pretty much Amazon. If I had to say, Amazon just recently got into the pharmacy business. They're definitely not doing things right yet, but obviously Amazon being a huge threat to everyone when they enter a market. So that is pretty much the only huge risk factor here. As far as everything else goes, I like the balance sheet. Them increasing the stockholders' equity by $5 billion is definitely nice. Again, increasing the balance sheet on both sides, not a bad thing. PE is nice. The earnings, very consistent except for the previous year. They've been at $6-ish billion for the past 2 years before that. So kind of like the earnings, especially being that consistent. I like the revenue growth, which is huge for a company that size. I like the dividend. Obviously, for a dividend investor, you can probably find better dividends out there, but I question whether or not you can find a better whole package there. So to summarize, for a growth investor, the revenue growth is amazing. I just don't think that can continue, and I definitely question whether or not that will continue. For a company with a market cap of already $95 billion, there's not that much room to grow. And again, with a revenue of $256 billion, there's not that much room to grow. And so if you're a growth investor, I would think that there's probably better opportunities out there, but I definitely wouldn't blame you for buying this company either. I don't think it's a growth stock per se. For a dividend investor, I think that everything works pretty well here. The payout ratio is low, so I would think that the dividend is pretty safe. Dividend yield of just under 3% is pretty nice, even for a dividend investor. Again, paired with the PE at the balance sheet, very nice. Definitely look into the stock. And for a value investor, the balance sheet is decent, the PE is very nice, the revenue growth is amazing, and the dividend is a very nice bonus on top of that, and I would definitely look into this company if you get a chance. Figure out what the risk factors are and how the entry of Amazon into the market plays out. Overall, I do still think that this is a very interesting company to look into and maybe invest in. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.